there's a lot of change coming there. There's a lot of inefficiency in the financial intermediation or in the way that the plumbing of the system. And I'm not smart enough to know exactly how it plays out, but to see that, whether it's stable coins or tokenization of assets, I think that's coming. And I think that could lead to certain businesses more precisely just disappearing. Just suddenly their reason to exist just goes. Because if you can directly own assets via a token, well, that might change things.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to another conversation in our series of episodes that focuses on markets and investing from a global macro perspective. This is a series that I not only find incredibly interesting as well as intellectually challenging, but also very important given where we are in the global economy and the geopolitical cycle. We want to dig deep into the minds of some of the most prominent experts to help us better understand what this new global macro-driven world may look like. We want to explore their perspectives on a host of game-changing issues and hopefully dig out nuances in their work through meaningful conversations. Please enjoy today's episode, hosted by Alan Dunn.
Thanks for that introduction, Niels. Today, I'm delighted to be joined by Richard Tomlinson. Richard is Chief Investment Officer of Local Pensions Partnerships Investments in the UK. He leads an investment team responsible for about £27 billion of assets. Has been in the industry for many years across the hedge fund side, multi-asset side, and consulting side before joining LPPI. Richard, great to have you on today. How are you doing?
I'm very good. Thanks for having me, Alan.
Good stuff. Well, we like to hear a bit about people's background straight away. Just to kind of, I suppose, set the scene. I know you studied engineering before getting into markets. How did that come about?
Yeah, I think partly it's a time-based thing as well. I left university around the turn of the century, so back 25 years ago. And at that point in time, engineering wasn't such an appealing place to work. Very, very different now. People with engineering skills, IT and similar. And I almost, to be frank, fell into working for a small hedge fund type manager. A personal friend said, here's an interesting job. We're going to have a look at it. I spoke to the recruitment person, and the rest, as they say, is history.
Good stuff. And so you've been on the kind of the hedge fund side, the multi-asset side, consulting. You've worked at some well-known names, GNI Fund Management, Auburn, Old Mutual. Through it, anything stand out, or what's kind of been the progression for you?
Yeah, I think if I look back, and there's obviously have to take a little pinch that we all rewrite history with the future, with the views and what we know today. But there was a little bit of evolution through how the industry evolved. So I think, as I said earlier, I almost by accident ended up working at GNI, where someone put me in contact with a recruitment person. I took the role, and that was good. And at that point, then it became clear how interesting what was going on within that, call it managed accounts, hedge funds, liquid markets type of activity. And I learned a huge amount. And that then essentially evolved and grew into working for Old Mutual Asset Managers, because they were both owned by the same parent company. And through that, then I learned an awful lot about how to build and manage portfolios, how to interact with clients, how to think about portfolio construction. And that was hugely helpful working at Old Mutual back then, over that era, which would have been 2004 to 2007. It was a broad multi-asset business, and I was relatively young relative to my peers. A huge number of mentors to people to learn from, and hugely helpful experience. So that was really great. And then how do I put it delicately? The world changed in 2007, 2008, and I left Old Mutual to think about other things, because they restructured the business. Frankly, I did my own thing for a year or two and did some work advising on managed accounts, an independent consultant, and if I'm really honest, I did a little bit of what you might call independent trading, which I think I'd probably say was I learned the most in a year in my career during that window that I think I've learned in any other year or 3-year window.
Interesting, yeah.
So I sort of had the bright idea of running my own little book starting in May 2008. And I was bearishly positioned, so I made some money. And then I gave it all back when markets turned early in the following year. And that I look at that experience, and took a lot of scar tissue, but also things I think about now when it's your own money and you're highly levered as your whole net worth. It brings a clarity of thought and experience. So I thought I learned a lot then.
Yeah.
At that point, then I thought, oh, this is quite a difficult way to live and pay the bills, and I moved back into a different role. And at that point, it was clear that the world had changed. This whole fund-to-fund industry was quite different. 2009, 2010. I didn't particularly fancy to try and step back into that kind of work, so I took the view to move. I joined Allborn Partners, which was, again, somewhat fortuitous. I spoke to the key people there, and they very helpfully, very fortunately, I'm very grateful for, they hired me. I worked there until 2017, and that was a hugely beneficial learning experience, a hugely rich environment. So, again, at the time I joined, I didn't realize what a great opportunity it was, I don't think. But looking back, the opportunity to work with some of the world's smartest, biggest, most global, institutional investors and asset owners was phenomenal. And then work in an environment where loads of smart people, high integrity people who were genuinely trying to do the right things for the right reasons, and serve your clients and understand, to deal with some of the challenges, let's just say, that the industry faced or has faced, and to really, a hugely rich learning environment.
Interesting, yeah. And then obviously since then, I think 2017 joined LPPI. So, I guess people in the UK are probably very familiar with that model. Maybe everywhere else is less so. I know it's kind of based on the kind of the Canadian model, but how would you describe what LPPI are doing, and maybe how you differ from some of your peers?
Yeah, so if you go back, around about 2015, the then Chancellor George Osborne had a policy or a view that he wanted to see, the government, the then Conservative government, wanted to see to make some changes to how the local government pension scheme was run, and they proposed the idea of pooling. And they started the journey that we're on. So the idea was they wanted to aggregate assets. So I think, if you look at what they were saying early on, I think there was certainly an element of looking at Canada and seeing what had worked there. And they had a handful of goals at that point in time, which was invest more in domestic infrastructure, reduce fees and costs, improve governance or evolve governance, let's say, and build scale. So you could see how that was going. And then the business I work for, LPPI, was formed actually at around the same time, but not necessarily purely driven by that pooling agenda, where two funds, Lancashire County Pension Fund and LPFA, came together, integrated their investment teams because they felt that the model that was being described was a better way to manage their assets. And LPPI has evolved significantly since those early days. And I joined in 2017. The business was founded in 2016. So yeah, if I think about what the LPPI is trying to achieve, it's to bring scale benefits and essentially look internationally for best practice for what good looks like as the optimal way, or what we see as the optimal way to run a large portfolio of assets on behalf of underlying partner pension funds, and drive benefits that align absolutely with those stakeholder goals. So that, at its very highest level, means creating call it a platform or an aggregator that is very focused on, at the highest level, paying pensions as they fall due affordably and efficiently. Yeah. So if you frame it amongst that, it's then look at the liability profile, design a group to do that, and so everything flows back from that. But it is, as I said, there was an awful lot of commonality between what we're doing and what the Canadian model, let's say in inverted commas, what that means.
Now, obviously, it's clear there are those benefits of scale in terms of, I guess, extracting kind of cost efficiencies and fee efficiencies, etc. But you did mention, working in Auburn and having that access and engagement with highly sophisticated international organizations. Is bringing a greater degree of sophistication to the investment process also, part of what I suppose what you're trying to do, and a part of the pitch to doing it that way, as opposed to leaving it to smaller local governments?
Yeah, no, there is definitely an element of us trying to, what we would say, as I say, I'm always slightly cautious when you say sophisticated, because sometimes our industry has a habit of building sophistication that doesn't
Yes.
always serve the
Yeah.
stakeholders or the clients or whoever you want to. But ultimately, it's looking at what is the optimal way to do that. And there's a great quote,
Yeah.
I think it's from Keith, I can never get his name right, Keith Ansbach, the guy that writes extensively on the Canadian system, the founder of CEM. And I forget, he quotes his view on like risk systems. They need to be complex enough, but not overly complex, or it's something like that. I've got that slightly wrong, but it's that idea. I think it's an Einstein derivative actually quote.
Yeah.
But it's that idea. It's getting it. You've got to be sophisticated enough to do the job properly, but you absolutely don't want to build in sophistication for the sake of sophistication, because that then creates complexity that can create additional risks that you might not want. But ultimately, it's designing a platform, team, process, business, whatever word you want to use, that is able to execute portfolios in the optimal way for align with client goals. But in more practical terms, that means building a very solid, investment due diligence, operational due diligence process, a portfolio construction process, risk oversight, governance. Building these things in a way and managing them in a way that we believe aligns with accepted industry best practice. So we're not trying to reinvent the wheel.
Yeah.
We're not trying to be super smart. We're just saying, we'll, like many areas, you do a little meta survey, you think, this is what we're trying to achieve. These are different ways of doing it. This is what we think good looks like. This we think is the optimal way of doing it. And how do we implement that in a cost-efficient, controlled way? So
So obviously it's pension money, it's long-term investing, I guess. The underlying clients are local authorities and the benefits are their employees. Is that fair to say?
The partner funds we work with, who also own us, are local government pension schemes. So I think that, I forget what the US would call them. They call them municipal schemes, I guess. They would probably call them state pension schemes would be the equivalent, I think, in the US. The beneficiaries of those schemes are the members themselves. But then you get quite a bit of debate over who actually, because the specific structure of the way the LGPS operates, the contributions from the members are fixed by Parliament, by statute, essentially, or by the ministry, by central government, and it's the employers who have essentially the financial risk that hold the performance count, if that makes sense. So contributions from members are fixed, contributions from the employers can flex. So it's the key risk constraint, and the thing you're optimizing for is actually managing the contribution level. So the goal, I think in the regs, we'll talk about stable contributions, affordable contributions. I forget the exact wording now, but it's essentially you're managing that contribution affordability for the employers. So if we do a great job, contributions go down, and it's more affordable. If you don't do a good job, they go up. And that then has direct line of sight through to local authority budgets. So, people, I've been known to say that if you do a good job, that means you can improve services or less cuts to services, or whichever way you want to view it.
Yes.
So there is real purpose and mission there.
Yeah, very good. And then obviously, I mean, from that feeds into how you think about, I guess, portfolio construction and the investment philosophy. I mean, it's I guess it's a long-term mindset. Would you describe it endowment style, or what would you describe the investment approach and the investment style or philosophy?
Yeah, absolutely. It's absolutely long-term. I would describe it as liability aware. I think people in the pensions world get very hung up on, is it LDI, liability matched, et cetera, et cetera. And I often will say to people, if I look at the UK corporate defined pension, the framing of that, I totally get what people did LDI and all that matching piece, because you have a very precise definition of liabilities. But within the LGPS, the liability and the discounting, it's much more open-ended, let's say, much more open to interpretation. So you don't have this direct, very precise matching of liabilities. Therefore, you have more scope. Therefore, you have more ability to run a liability-aware long-term approach, which then means looking almost like over the horizon and being much more strategic about it. So the way I'd think about it is I love my job. It's a great job. You have a very open-ended and actually quite complex, thorny set of goals to meet, which is building. And if I had to really summarize it, you've got to build capital, invest to build capital for the long term to pay pensions of the future, whilst managing liquidity and cash flow to pay pensions of today. And the portfolio, we believe, certainly as LPPI, that we think is optimal, looks a lot more like an endowment style portfolio based on that. If you think what I've just described, that sounds a lot more like endowment management than a very heavily hedged UK style DB corporate pension scheme.
Yeah, yeah. So obviously, let's just say the portfolio is drawing down to pay benefits at the moment. What kind of percentage of the portfolio is kind of drawn down every year?
Yeah, so and if you went back 10 years, the majority of LGPS schemes were cash flow positive, so i.e. contributions were greater than the outgoings in any given month or quarter. Now it's increasingly rolling over as the schemes mature. But at the moment, as I say off the top of my head, I haven't quite got the numbers to hand, but it's low single digit percentages in terms of cash funding needs, but that will accelerate through time on average. So there is a need for increasing cash funding as the schemes mature.
Yeah. And the way you're set up, you basically manage distinct pools in different asset classes, and the underlying partner pensions can choose or you can work with them to set the asset allocation. Isn't that right?
Yeah, that's exactly right. So the model we use, which is a little different to some of the other pools, we provide advice to our partner funds and say this is what we suggest asset allocation is, but they own that decision and give it back to us. Essentially, they say. And for example, they might say we want 45% in listed equities, 10% in credit or whatever it will be. We then have broad investment, what we call investment pooling vehicles, which then you can invest to meet the asset allocation. However, the structure we're using is we've always run with what you might call we call it whole portfolio management, our whole scheme management, so I should say, where we take the whole portfolio and manage that on a fiduciary basis. So we are managing all the cash flows. So we do have some assets in pooling vehicles, and then we'll have some which we would call balance sheet assets, which are directly from the scheme's balance sheet, which may be legacy, or it may be something that's not common to our other partner funds. So maybe a bespoke investment directly for them, such as a local investment sleeve. So that's how the portfolio comes together, but we manage all of that for them, do the heavy lifting of implementation.
So in that sense, you're probably like an OCIO. Is that fair comparison to draw?
Yeah, it is. So I had funny enough, I had this debate earlier this week with one of the very large bulge bracket banks, the US banks, who I won't name, but they have to do some head scratching to define a little while back what OCIO meant, because different people means different things to different people. I would define the activity when take as an OCIO, and by that, what I specifically mean is I'm using the definition that now seems to have been evolved by the CFA Institute and others, which is you can provide advice to an underlying asset owner on the strategic asset allocation. They give you the asset allocation, you implement the portfolio, and you report back to them. But they still own the SAA decision, which is a little different to the fiduciary management language that we use in the UK, where that means you just get given some goals, meet this liability profile. So that's the definition I would use. And I would describe us as an OCIO in that context.
And obviously, as you say, you advise the underlying schemes or partner groups, and it's up to them to set the strategic asset allocation. I mean, is it quite similar across the different groups you work with, or notable differences?
It's broadly similar. They're not all the same. There are differences. So we have two of our partner funds have funding levels above 100%, and we have one who's a little bit lower. So let's say, so they have slightly different dynamics in terms of how they are, the sort of risk appetite, let's say. So our process would be to start with risk appetite, frame that, and then put that into an ALM model. And so the two that have sort of, let's say, higher funding level have more similar asset allocations. The one that's slightly lower has a slight different allocation, but broadly, you've got to get quite granular to start seeing the differences, to be honest with you. Those are the big leaders. They are all, in the 45, 50, 60% type equity risk levels, or allocation, sorry.
Yeah. And okay, that's interesting. So if they're long-term investors, but they're not 100% equities, I mean, how do you think about what's the right allocation, how much equities, how not, what else goes into the mix?
Yeah, so something we've done a lot of work on over the years, and actually we published a paper on this, our Smile paper, let's say 6 months ago, and we've got something else quite similar coming out soon, talking about the role of illiquids and alternative assets in a broad pension portfolio. Is it a feature? Is it a bug? Is it volatility laundering? Is it not? Type thing. So, yes. and I think we're trying to put that in context and have that grown-up conversation around that. So, in broad terms, if you're a long-term investor, you need, and you care about long-term affordability, you need to be running risk to get the right trade-off, because with any process, there's the trade-off, let's say, between surety or security of returns and affordability or quantum of return. And that's exactly the same for us. So it's all very well saying de-risk because you're above a certain funding level. But if you do that, you're then putting more of the workload in the future onto contributions. So you're asking from future generations to pay. Whereas we would probably argue you want to run the capital you've got appropriately, not be overly risky, but try and find that sweet spot where you can hit call it an efficient portfolio where you're managing future contributions, but you're also sweating the capital you've got today. And in our mind, that means a portfolio that really, again, goes back to, looks more like an endowment portfolio. Healthy risk of equity risk in there because it's a whole different conversation as to why equities might return more than risk-free over the long run and what the risks are of that. But balance that off then with a range of other assets, but fundamentally a relatively low weight to traditional fixed income and direct duration. So to put some meat on those bones, what I'd say is we've got something like 20% circa real assets, maybe actually near 25 in some cases, a reasonable slice of credit, but it'll be shorter duration and a decent chunk of that will be private credit. We do have some exposure to hedge funds at times, but it has been a smaller part of what we do. There's been a small amount of private equity in there, but think in the 5% range. I think that's everything, isn't it? And within the real assets is real estate and infrastructure.
And obviously it's long term, so you're not too hung up on markets this year, next 6 months, etc. But when we're at a point in time like we are at the moment where, a lot of people will say, well, valuations are on the higher side for equities. And, if you look at the studies, everybody sees, current valuations versus historically what has been realized in terms of 10-year returns, etc. It's somewhat sobering, I guess. So how much do you worry about, a lost decade for equities or, a prolonged period of kind of subdued real returns in equities?
Yeah, and that was something you definitely think about. But there's also the question of if you don't own equities and other things and sort of call it risky in inverted commas assets, what do you own?
Yeah.
So I think I think betting the farm on what equities will do over the next decade and trying to put a number on it, I'd be very reticent on that. And what I often say in this conversation is I don't know if equities will beat fixed income over the next decade. Not just now, I'd say that. But what I do know, I think, is if you have a sensible investment principles and you invest and you manage the portfolio appropriately, a portfolio of risky assets with positive carry and spread on there is likely to outperform running less risk in the medium term. And I think and the here and now, the thing I worry about is that interaction of valuations are quite high, but that could be for a reason. If I look forward, do I think inflation is likely to print at 2% or maybe more like 3% or maybe even a bit more in the next decade? I think I'm going to go for that latter view. I think about deficits. I think about the reaction function of fiscal and monetary authorities. And I think about the geopolitics, all that stuff. It doesn't make me want to own a lot of sovereign bonds or similar. So you go back to what do you own? And then I think, if we're going to segue potentially slightly into a more volatile, risky environment where you probably want to be a bit more tactical. And so there is clearly risks to the equity thesis. You have to own more, but I'm deeply unconvinced you just want to own a big pile of, what's the word I went to look for, passive fixed income.
Yes, sure. And obviously it is approach a lot of people in the private sector. Obviously private pension schemes have gone down the LDI route and, in many cases were encouraged to do so. Obviously you don't have that constraint and you're kind of managed a different way. But it does sound like that macro conditions are part of your thinking. It's not that this is constructed in isolation from what's going on in the world. It sounds like you're a believer that we're into an environment of structurally higher inflation. Is that the points on this, I suppose, have been well talked about, higher government spending, etc. What's your particular lens on that that's going to likely drive it?
Yeah, absolutely. So, and within the way we frame things is like we don't try and be too cute on short-term macro calls. There are a couple of people on earth who have got an edge on that, but I'm not one of them, nor is our team. We don't try. However, in the long term, I think there are some things you can think about and look to, and especially where our long horizon is investment and, how do I put this? We can warehouse volatility. We don't have to be deeply hedged. We can run risk. So when I look through that, and I think what is likely to happen, the different scenarios that are likely to happen in the next decade, And you got to think, what would you need to believe to think that we're going to have low inflation, long-term interest rates are back to 2%, everyone starts playing nice, the peace dividend goes back to being a dividend, not a tax, whatever you want to call it.
Yeah.
You've got to make quite a lot of assumptions, and some of them are Herculean. So I think balance of probability, for example, I often say this, if I'm going to own, I've got no issue with owning duration, but I'd rather own second order duration rather than direct duration. So I'd rather own second order duration through owning real assets, because there's an implied discount rate in there.
Okay.
So, because then you've got some asset backing and you got something real. And I think inflation is, I'll go on a slight segue, something I've been thinking about quite a lot, but you think everyone in the UK, I can't comment on, I'm not so familiar. Everyone in the UK is obsessed with house prices. You see these charts going like this and they say house prices have gone up loads. But then you go, but that analysis doesn't make any sense to me. You've got to disaggregate land value from what's on the land, cost of construction.
Yeah.
And now you start looking at cost of construction of an average house in the UK, it's not that dissimilar to the average price of a house in the UK. So you can start thinking through that has changed a lot in the last 5 years. And the value of the land is a long duration asset, ultra long duration asset, maybe the ultimate long duration asset, huge impact on interest rates. Your cost of building bricks and mortar is absolutely linked to inflation and the cost of doing it. So again, when I think about the next decade, is it going to be cheaper to build a house in a decade or so, or a building or a shed than it is today? Find that hard to believe, really hard with demographics. So that's kind of underlying the thesis. It's that looking over the horizon, what's likely to maximize our probability of paying pensions as they fall due over the next decade or two. And I think it's something with a real asset-y style portfolio, and that's including high quality equities and things that are defensible cash flows, all that sort of stuff.
Yeah. So as you say, it kind of leads you towards more of a risk growth oriented portfolio. Obviously, the composition of that is still up for discussion. I mean, you touched on private equity at 5%. I think you said, which is not extraordinarily high relative to some of the numbers you hear, particularly in the US. So how do you think about that debate, public versus private? Is there an illiquidity premium or not? Or what's the attraction or the unattraction of private equity in that sense?
Yeah, it's interesting. So I'll go straight off with something that sometimes gets me in trouble as a statement, but I absolutely reject this idea of illiquidity premium and then you always get paid for it. It's a really neat marketing thing. If I was selling a private credit fund, I'd be using it all the time. But what does it really mean? So in my mind, if you're a bit more sophisticated, you step back, people say illiquidity premium. Most people know that what does that really mean? The academics would break it down into a whole series of things, but to a practitioner, you'd probably say, well, there's some complexity premium in there. There's some kind of sourcing premium. It's a whole series of other things. And that can be positive and negative. So I would say, I would absolutely agree there is a spread between public and private. It's time varying. It can be positive and negative. I absolutely kick back on the idea that you had, say, 5-10 years ago, where pension funds were saying the narrative, we're underfunded, therefore we've got to invest heavily in private markets and private equity. I would reject that absolutely. I've got no issue with owning a lot of private equity, but don't just do it because you think it's going to be a return kicker, because it might not be. And in private markets in general, I would say there are really good reasons to own a portfolio of private markets that may not be able to do with return. It may just be you want pure play exposure to certain things. There's certain things we want pure play exposure to for whatever reason. You can only do it in the private markets. And a really obvious example is local investing. Local investing is very important to both our partner funds and government as well. Central government is pushing Fit for the Future in that direction. It's stated, well, if you want to invest, if you're a pension fund in the West Country or wherever, you want to invest in something, you're probably not going to be able to do that via listed markets. So there are lots of reasons to think about private markets, but the idea that it's just about excess return is one that I think is flawed and dangerous, frankly.
Yeah. And then on the public side, obviously, historically, I guess you had kind of home country bias for in lots of cases. And I get the impression that's changing. But being, I suppose, a UK domiciled plan, and you have to think about currency risk, etc. And if you benchmark yourself versus the global index, you end up picking up a lot of US exposure. So how do you think about all of those factors?
Yeah, that's a really interesting one and a pertinent one at this point in time.
Yes.
So we've certainly, as part of the broader government, call it policy backdrop, we've certainly thought long and hard about how much we have in the UK, as is everybody else, because government has made some very clear policy signals and are implementing that. So we have, off the top of my head, it's going to be in the 20-25% of our portfolio in the UK, something like that. The bulk of it's in the private markets. And the challenge if you talk about it from a political point of view, or from people looking at the thing, people will say UK pension funds have very little in the UK. We're double benchmark weight in equities in the UK, but it's still only 6% because the benchmark's got 3. So it's all about that lens. But I think the really interesting one is how domestic assets help you meet your long-term liabilities, because our liabilities are linked to UK CPI inflation. So there's some good reasons why owning some UK assets can help you meet that long-dated liability, because there's either direct linkage or indirect linkage to CPI. 2, you've got the currency transmission channel back to inflation. Weak sterling tends to drive inflation. So there's a little bit of a currency hedge if you own some overseas assets to your real liabilities long-term. So I think there's an element of that. But then obviously the question is, you do end up with, and we have international benchmarks, we have a reasonable exposure to the dollar, and that has been a little bit painful this year, as is well known for people. We do offer our clients advice on FX, so we do offer a range of options. So our partner funds make the choice on how they want to approach FX. So we can do different versions for them. Some of them do a degree of hedging, and we also hedge in the investment vehicles for nominal assets. So I'm not sure I've quite answered the question, but that gives you an indication. We do have a reasonable degree of overseas non-sterling, non-hedged exposure.
Yeah. And then in terms of kind of security selection, and we should say some of the trading and investing is done in-house and some is done externally. Is on the equity side, is that more in-house?
Yeah, it's about half and half. So of our partner funds have around 45-50% of their portfolios in global equities, and around half of that equity piece is managed in-house.
Yeah.
And the other half is with external managers, so to complement or to build on the internal piece. And I think the way we've approached this is, again, if I go back to what we're trying to achieve, if I think about the goals, it's quality compounding, really. When you think about paying pensions long term, you want to compound quality, in inverted commas, over time. So i.e. build a strong capital position with contained risk as much as you can. Risk is obviously unknowable, but you try your best to do that.
Yeah.
And in our view, the way you've got different ways of investing in equities, but part of that is owning, that quality approach, quality to reasonable price, whatever you want to call it. So that's the backbone of what we do.
Yeah.
And that then maps very neatly against those long dated liabilities. Internal strategy focused on, as I say, sort of Buffett style quality compounding. And then there's a handful of external managers. 1 or 2 have also got that quality type of approach to it, and 1 or 2 are a little bit more, do something a little bit different, let's say.
Yeah. So that's it's very much driven by that factor lens, if you want to call it factor or style lens, as opposed to being more benchmark driven.
Absolutely.
So presuming that leads to a slightly different orientation in terms of exposures to the Mag 7, some of which I guess are quality, but some maybe not at a reasonable price. Do you tend to be quite different from say the MSCI world? Would you say?
Yeah, we do. I think, if I'm honest, it's been being an asset owner who's got active equities managed, that's been quite difficult for the last few years. But I know we're not alone. We are behind MSCI World in global equities. I think many others are as well in our position. And that is, if you start thinking about that factor lens, most people didn't own enough in NVIDIA. So NVIDIA went up a lot, and it was a very heavy weight in the index. Time will tell how that plays out. Who knows? The AI has been a huge thematic in listed markets, and generally much, much more than just NVIDIA. So we have been underweight that factor, which thus far has had performance implications, let's say.
Obviously, going back in your career, you have started off on the hedge fund side, and so you are very familiar with hedge funds, multi-asset, all of that stuff, active strategies. And you mentioned you have had that in some of the portfolios over time. I mean, you obviously can still see a place for those strategies in a long-term portfolio.
Yeah, I can actually.
Yeah.
And I think it goes back to this sounds like portfolio construction 101, but it's what role you're looking for.
Yes.
And I keep coming back to it. Sounds stupid. I've been doing this for a very long time, and yet I still sort of find myself remind myself to say, is this an equity type substitution product, or is this something because I don't want to own bonds in the more balanced part of the portfolio? And I think that depending on, I'd say my view would be hedge funds is, people use this generic term. It's a nonsense. To use the nicking this from my old employer Allborn, hedge fund is a business model, not an asset grouping. So it's
Right.
what is that? And I actually take this one step
Yes.
further. That I go, you start looking at what the big multi-funds are today. I was still in, I was born in the mid-70s, but I wouldn't have seen what Goldman and these those banks were and Solomons in the 70s. But I can imagine they probably didn't look that dissimilar to the way the large multi-funds operate today, which is just a slightly different version of a set of pool of capital. And then you start linking that back to what is the purpose of that trading strategy or activity. And then you got to think about what the costs of running it and what is who's wearing what rewards. And the reason I say that is because people get quite het up sometimes about fees on hedge funds. So, I mentioned the big multi-funds, they look horrendously expensive. I'm not saying anything I shouldn't say there. But then you got to think about what activity is driving that outcome, the stream of returns, and how does that work? And the same for each other strategy. So I think there is a role for these things. It's just a case of putting them, is this an equity substitute? Is this a fixed income substitute? What role do I want it to play? And is the fee structure and the split of economics fair between the capital provider and the manager? And sometimes it hasn't been in the past, let's be honest. But that's not to say it can't be in the future. And I think there's a much more mature conversation on that now than there may have been in the past. So,
and what about, some strategies obviously are generally, I suppose, considered for their diversification benefits. So if we talk about things like global macro or CTAs, that had that propensity or ability to deliver performance in major down years like 2008 or 2022, etc. But at the same time, they're not necessarily fixed income, and equally fixed income can sometimes be down with equity. So things can defy, very much being jammed into these kind of either growth or defense buckets, and then depending on what level of volatility a strategy is running out, it could be a revenue or a return generator or a return driver as well. As you say, it's important to simplify things as much as possible, but not too much. How do you kind of balance that simplification where there are these complications?
Yeah, it's interesting. So maybe this is, I'm sure you probably had this debate where you take a CTA trends portfolio. People will throw the words around, it's long vol. VIX spikes, correlations jump, and it goes down. And they go, you failed. And it's like, well, it didn't quite mean. So I'm really careful now. When I'd be like, I'm defining long volatility as generalized economic or market volatility and over a time frame. And so what I'm getting at is you've got to get the complexity of how a trend follower works, what time horizon, what contracts they're trading, all of that sort of thing. Because but the idea of a macro or a CTA strategy, something that can be genuinely short, generalized risk, in inverted commas, I do the little thingy things with my that it is incredibly powerful in the portfolio, because you do get times where any risk asset gets hammered, liquidity gets washed out, and everything's going down, and you've probably only got one or two things you own that might just be able to stand up. Cash might be one of them, or potentially macro or CTA. And then not to get completely caught in it's gone down for the first 3 days, because keep it as simple without getting too technical. You get the big correlation spike, you get the big vol spike. Everything blows up, everything correlates when everything goes down. But then when that unwinds in the coming days and weeks, suddenly you get a reversion. And that is when you find that that's when that decorrelation piece can really help. So it's being quite precise on how you talk and frame things. So as I say, I think personally, it's all very well saying we're going to be 100% risk on, and we're not going to worry about some things to hold up the portfolio when everything goes out the window. And then if you want to get to the next level, which I think is really fascinating, is then thinking on the liquidity side, is having things in the portfolio that provide you cash and liquidity when everything else is getting hammered. Because there are times when, take a simple example, you can say we've got liquidity in global equities. Yeah, sure. But are you really going to want to start liquidating global equities when they're down 40%? Now, you don't want to use a CTA as a cash machine, obviously, but finding things of ways you can structure bits of the portfolio that might give you an automatic payout, either that's a derivative position or similar, but finding ways that you can manage that liquidity, because it's not just mark to market, it's also cash, is a really interesting piece of work to do, let's say.
Yeah. So it sounds like some of the clients have used kind of diversifiers like that at some point, but not everybody. I mean, if it was down to you, or if you had a blank canvas, do you have a kind of asset allocation model? How much would you prescribe to allocate to alternatives, or is that too much of a loaded question?
No, it's fine. I'll happily, as I say, I don't own the SAA for our partner funds. They tell us. However, I'll use the obvious get out that you've got to go back to the goals about what someone's trying to build. But if we start on the assumption that you're running an endowment type portfolio where you want to manage risk, but you're not, you don't have to be crazy short term with some kind of VAR limit. You can look over the horizon, but you want to be thoughtful how you do that. I would probably argue that there is you're going to want to have a reasonably hefty chunk of equity risk. So what can you do around to diversify some of that? I think there's then a thoughtful degree of thinking about real assets and duration. And then you move into the stuff that is genuinely different. And that might be insurance-linked strategies, which some people may or may not put into the hedge fund bucket. You've got the sort of more market neutrally type equity strategies, fixed income strategies, which I think have a place, but just be aware of the vol and correlate or the VIX and correlations sensitivities short term on those, but fine. And then you move into the stuff that I think you can genuinely put your hand on your heart and say can really make money when everything else is going down. And that is predominantly macro CTA, GTAA type stuff. And I think I would probably there's many versions of the world where I'd rather be invested in that than sovereign fixed income at times. It's looking forward. Are you going to put 50% of your portfolio in it? No. But 1 or 2% doesn't really matter and doesn't move a needle. So, if you're thinking, in my mind, you'd probably be thinking somewhere in the region of 5%, maybe up to 10%. But then that's back to a question of scaling risk. If it's a 30-volt CTA, you might size your position a bit lower than if it's a 5-volt CTA. So.
Yeah, no, exactly. That's the important point that's often lost in the debate. It's what level of volatility. In terms of kind of portfolio construction, obviously you've kind of mapped out an asset allocation. How are you thinking about kind of risk and portfolio construction? Do you translate this into, okay, this will map into a portfolio that runs at about 12 or 13 vol, and that means might have a drawdown of 25, 30% over time? Or do you have a kind of a different framework for thinking about risk?
Yeah, no, we certainly think about that. We're not, the way, so to get to just a little bit more detail, so our primary constraint is the triennial valuation in terms of risk framing. So every 3 years, our partner funds will talk to our actuary, who will then look at the portfolio and define what contribution levels that will set. And so then you're thinking, we've got to build an SAA, run a portfolio that means that works and makes pensions affordable in the long run and has sufficient liquidity. So it's quite a complex process. But in terms of that, absolutely, I would probably, in some ways, in my mind, I'll just look at it relatively simplistically. But if you're thinking, if you're 100% equities, you could be down 50% in a not very long period, let's say a quarter or 2 quarters. That's plausible. So obviously that would be very, very, very challenging for DB pension funds such as ourselves for so many reasons. So you're going to come back from that level. Then you're going to try and say at what level of, if we're talking vol or drawdown, does it feel more reasonable? You're probably going to try and bring that down, not to crazy levels, but volatility levels of 8%, 10% are manageable. If you're running at the 4s and the 5s, you're not running enough risk probably to meet the liabilities long run. And if you're running in the 2025s, you're going to blow yourself up. As a slight curious aside, which is one thing I observed, I spent an early part of my career when I was at GNI building models to look at structured products and running specifically CPPIs and things like that. And when I started looking at the maths of the defined benefit pension schemes, it's quite similar. The stochastic framework, but it's also what a trader on a structured risk would call gap risk. And a defined benefit pension fund, it's your funding level. The gap between your assets and liabilities, which in a CPPI are similar, is your bond floor. So therefore, that defines how much risk you can run before you hit the knockout. So it's interesting. And it's very much like running levered CTAs. It's exactly the same idea. So you can draw those parallels. So then you start thinking in that way. But there is going back to the stuff I looked at many years ago, you got this inverse relationship between expected return and leverage. Because at some point the leverage gets too high and your risk of blowout goes through the roof and you blow yourself up. If it's too low, you're not running sufficient risk to defer the costs.
What about, obviously, inflation protection is a key part of it, and you obviously have a healthy allocation to real assets, and in theory, you get that via the equities as well. What about commodities? Not just precious metals, which are obviously topical at the moment, but more generally, managers giving traded liquid exposure to commodities. Is that something you consider?
I think what we try and think is what risk factor it builds, and a lot of people own commodities because of the inflation participation. And I think if you start breaking down the inflation conversation, I talk about you've got to think what sort of inflation. You can own something that supposedly correlates with inflation, and you get about inflation that gives you zero benefit because it's the wrong sort of inflation, i.e. supply side versus demand side, monetarism versus cost-driven type inflation. And you look at history, and people will tell you that owning oil is good because that tended to lead. But that was like when you had an economy where oil was a huge part of the inflation basket and drove inflation. The world's changed, so you've got to be quite mindful of that. But the idea of owning things that are participating in inflation for the long run is helpful. Owning oil has been more challenging at times for people because of some potentially climate and ESG type considerations. The way I would think about it, though, is I have to say goes back to trend following or some form of active management of commodity exposure. So if you do get a breakout in the commodity complex, something that can then start giving you convexity into that, and that again would bring you back to some form of trend, some form of CTA type exposure. I'd probably rather go down that route than owning oil or any of these commodities directly.
Yeah, fair enough. And I mean, is that something? I mean, you touched on ESG. Is that a big focus, or do you tailor that depending on the underlying client?
So the way I'd frame ESG is one of those things where it's a word that it's quite difficult to talk about at times because now, or what set of words, it's got politicized, rightly or wrongly. It was always politicized. Who knows? I think you have to start breaking out the ES and the G first of all. And actually, first of all, there's two key points I'd make. One, I normally talk in terms of stewardship and real world outcomes, not ESG. And two, even if you're going to drop into ESG, talk about them as an E, an S, and a G. So on the first point, I think your job as any fiduciary or owner of an asset is you've got to be a good steward of it. You wouldn't buy a house and then kick holes in it and then think you're going to sell it for more if you've knocked around all the walls or something. You're going to be a good steward of it. You repair it, you maintain it. You're trying to maintain financial value from the assets. So I think a lot of it comes back to that stewardship. On the real world outcomes, everyone wants to see better outcomes in the real world, but that might mean affordable housing for the less well-off sections of the community or whatever. I don't think that's particularly ESG unless I think that's just being, especially for a quasi-sovereign group, you're thinking about the world that we live in. It's that type of thing. So to me, it's about stewardship. And I think in terms of ESG, it's got a challenge. But certainly the way we've always looked at it, we've defined it as financially materiality. So where you think about these things is where they have a financially material impact on the investment portfolio. So it's risk management. It's not about political posturing or woke or anything like that. It's about if there is a financially material impact on our investment, then we care. And then you break down the ES and the G. The G is about governance. Well, you speak to any hedge fund manager, say in the equity world, they're going to care about the governance of the businesses they invest in, right? One way or the other. They're going to say, I want to be able to remove the chief executive if they're not doing a good job, so I want my governance rights. So that's the governance piece. That's always been there. The S, I think, links to the real world outcomes. It's about that social fabric of, it's probably going to be value damaging for your business if you pollute demolish a load of houses in the local backyard and put something there that people don't want. You've got to be mindful of that interaction, that political piece. The bit that's more difficult, obviously, is the E, because that's then dealing with the externalities and who pays. And that's the bit where I think we're having the debate. That's a political question. I view my job, I'm an implementer. I'm an instrument of implementation, not a politician. So I'll do what my political masters tell me, basically, on that one.
Yeah, fair enough. Just going back to the kind of the hedge fund side, and you did touch on kind of multi-strats, high fees, etc. But I mean, I guess the proposition from the multi-strats and the larger ones have definitely been able to deliver it. It's kind of high single-digit returns fairly consistently, and some years maybe a bit better. But I mean, it's more around that consistency. Obviously, by blending many strategies, they're able to boost the Sharpe ratio and achieve that kind of high single digit with low drawdowns, etc. I mean, nothing to say that they will always be able to do that, and that's the big question. But from your perspective, does that not look attractive, or is it just the fees means it's a no-go as a conversation?
So, every time you look back at the history and you think, surely at some point the big multis must fall over and the returns must stop, and yet they keep going. So I think you'd have to be somewhat either idealistic or naive to say the return stream doesn't look very appealing. Okay. The challenge for people like us is the cost. So, the fees are very, very high on optically when you look through and say how much you're paying on capital. when you look at the activity that's taking place, going back to my you're running a business comment, well, is it silly? Because there's, I jokingly say about equities, if you're going to be in that low latency HFT space, you need to spend hundreds of millions of dollars a year on tech and trading firepower. So that's not free. So I'd put it in that context that there are challenges around the multi-model. I absolutely, as a pure investor that doesn't care about fees at all, I see the appeal, and I would frame it exactly like you. I'd say, look, what's your source of value? It's the running your own hedge fund is difficult. People can join and make a very good living. Let's just say that's putting it politely. And these things, a lot of the pain of running a business gets taken away. Yes, they run very high leverage. They counter that with very aggressive risk management and all this other stuff, and they have strong relationships, and they've made the pools of capital running less liquid. So, and they have a significant market footprint, which gives them an edge. So you add all that up, you can see why that might make money in the long run. But for us, it's fees is the big one really for us.
Fair enough. And maybe moving more broadly in terms of manager selection, obviously you mentioned some strategies internal, strategies external, and I guess you got anything you're running internally, you got to be comfortable that you have the in-house expertise, that the infrastructure is suitable for the strategy. Any other consideration that would help determine what goes in-house versus external?
I think the big one for me is at the top level, it's got to serve stakeholders. It's got to have its place in the portfolio, and it's got to be to the benefit of our stakeholders. And that means partner funds, client capital, that type of thing. Because someone gives you unlimited funds, you can probably do anything. But why would you? So I would always come back to what's the investment case? How does it benefit stakeholders? And then is it coherent? And I'd probably just go back to a little bit, my degree, I studied Michael Porter and Five Forces and that sort of management consulting-y type approach. I tend to take a very simple make versus buy, back to the production engineering type stuff of doing things in-house. So you would only make something in-house if there's really strong strategic reasons for doing so, and it's within your risk appetite, and you can do it appropriately. Being blunt, that certain pay rates for certain people just don't fit within what our risk appetite, what we can do, because they're just the amount of incentivization that's needed to get the best people. We just can't do that. And in the risk appetite of the organization. So, and then most important, just as importantly, actually, I'll say it very openly, that there are certain strategies where you can pay a third party a very, very, very competitive fee to suck up a lot of the operational risk that you'd have to wear yourself. And you're never going to do it as well as them. So how is that serving your stakeholders by trying to do that in-house?
And then other considerations when it goes to external managers. Obviously, you've been on the hedge fund side, you've been deep in the weeds on manager selection. So you know all of the ups and downs and the behavioral biases, etc. So how do you think about starting with the top of the funnel, narrowing it down to managers you actually allocate to?
Yeah, so top level, it's rolling portfolio. What do we want to find? It's there, starting with the need, portfolio need, and how that fits together. You then move into, just to be clear, I don't think we're doing anything particularly revolutionary. Stating the obvious that you're looking for, edge, you're looking for credibility, the principles having good, you call it 5 Ps, whatever you want to call it, but it's the team, process, credible platform. But when the performance for me is one where people get hung up on performance. To me, whenever I look at a track record, it could be good or bad. It's always then how is it driven, and then the way I would look at it is I frame what the manager tells you, frames what they say they're doing, and then you look for evidence that is true. It reasons to believe in the track record. So if they tell you they're running a certain positioning with regard to volatility or whatever, and you see that it just doesn't correlate with when they make or lose money, that to me is where the numbers come in. And then obviously you do as much of better risk assessments, but for me it's fundamentally portfolio fit, credibility, edge, and then risk profile.
And I mean, in terms of kind of edge, credibility, team, obviously they're all qualitative factors. Is there anything that stands out? I mean, is there a label you'd put it or a thing you like to see in terms of the focus, or some people don't like big firms, asset gatherers, they're not focused on alpha, or, some like smaller firms, anything like that?
Yeah, really interesting question. So and being candid, I'm slightly further away from the managed selection piece now. My deputy Dev Jajeda is much more in the weeds on this than I am now. But to my mind, because we're running multi-asset portfolios, we have different portfolio sleeves. Let's say you have a slightly different feel in different areas of the portfolio. So we've been really careful not to have blunt rules, like say minimum 3-year track record, minimum AUM. We're very flexible on that, but there'll be different parts of the portfolio where you prioritize different things. So as an example, if you're looking for someone to run multi-asset credit, you're probably going to lean more towards a global platform because it's about breadth of opportunity set and depth and that institutional platform. And there are elements of, as a large allocator, we need people to be able to take the volume of capital we've got. But there are other areas where we can and will work with much smaller management groups who have a very different ODD risk profile, let's say. So again, the ODD, we take it in context. We have a very detailed process, very senior, mature team on that side, and we can take a view on that to say, well, we can accept that because that's coherent with the manager. The one for me personally that I would hold dear is integrity. So it's a really important one. The business, integrity of the principles, integrity of the business. That if we perceive there is lack of integrity that is genuine, then that is a big issue because we're ultimately public funds are running, so we will hold people to a high bar. In my mind, if we sense there's impropriety, we are aggressive. We're very aggressive on that.
In terms of the governance and evaluation of LPPI, I mean, obviously it's not an easy task to assess if you guys are doing a good job or not. I mean, and I'm sure there are plenty of people tasked with examining that. But I mean, what do you think is the right way to evaluate the success of an organization like yours?
Yeah, it's really interesting. So I think I said at the start, when George Osborne and the then government put in place pooling, they set out these 4 goals. We smashed through them, frankly. We delivered them. I think we've had 200 million of cost savings since inception. Performance has been good. We've done significant. We've built an infrastructure manager, frankly, a direct infrastructure manager in partnership with Greater Manchester and some of the Northern Pool. So we've done very well on that. But there's more to it than that. And what we found is evaluating performance, just like hedge funds actually. You compare 2 equity long-short managers. The higher returning one could have done a bad job, and the lower returning one could have done a great job because it's all about the strategy, what they told you. And our context is very similar to that. So where we've got to, if I'm honest, is we're very close to agreeing what we've called a balanced scorecard with our partner funds and client groups, which looks across multiple dimensions. So break the scorecard into 4 quadrants essentially. So again, an idea that's not similar to production, manufacturing, or engineering, that sort of idea. I guess it's right. It's performance, risk, sort of non-financial factors, and sort of contribution-y type stuff. So if you think about what matters, if you look back in 10 years' time, you wanted to have that scorecard. If all those things are green, you think, we've done a great job. And so it's not just relative return; it's relative and absolute return. It's the costs of the pension, the funding, the income. There's many dimensions. So short answer to bring it together: balanced scorecard, key KPIs, and then report on that on a quarterly basis. On that basis, we're looking good.
It's interesting the balanced scorecard idea when you say it sounds right, but then I guess investors invariably put 80-90% of the weight on performance, which rightly or wrongly, but it is funny how we kind of default to that, where it does make sense to kind of think in that kind of balanced scorecard
well, but
way.
Is it not, if I invert that statement a little bit? If I think about you, I'm sure you many times like me have run a Markowitz style optimization, and you crash straight into corner problems. If we were building a hedge fund portfolio 20 years ago, it would say let's get my dates right, maybe 20 odd years ago, 2005, put all your money in convertible arb. Completely missing the fact that at that point, I think 75% of the world's converts were owned by a handful of the converts managers. The risk profile was there, but you were just selling the tail, basically. It's right around here. So selling the side of the left tail. So that is what I'm getting at. So I'm sure we could find ways to, and want that pure performance dimension or cost, for example. As I've jokingly, there's different ways you can do this. So you have to think holistically and how it meets the mandate, because it's multidimensional.
Conscious of time, we're coming up to the hour, and we do like to get a bit of perspective from our guests before we finish off about maybe advice to people, both from a career perspective, investment perspective, and also when you've done a bunch of different things, consulting, hedge funds, multi-asset, which probably has yielded benefit. But I mean, what's been influential or helpful in terms of things you've done or things you've read or people you've worked with, and anything that's been hugely helpful for you?
Well, I think the advice I give people, and I speak to youngish people leaving university, what I'd say is that it's this idea of the wind at your back. And it's in both the investment portfolio and your career. So don't try and push water uphill, is another cliche you could use. So when you're thinking about what your next steps are, make sure it's a growing industry or a growing space in the industry. So if you're in that space, you can be a lower performer and still do well, as opposed to being amazing and still not being able to get a job and struggling. So, thinking about your career dynamically and pivoting through that. So it's that. And then obviously the parallel in the investment portfolio is if you've got the structural growth, you can make mistakes on the way, or in the right strategy, you can make mistakes and you still do okay. So it's that type of idea. The other thing I'd talk about is just, keep integrity and that type of thing. That it can be really tough at times in your career to do the tough thing in the short term that is painful and hard. But if you fold and people find out, people see it, and then it can be very painful to fix it later down the line. It's the idea of a reputation takes a lifetime to build and a heartbeat to lose, that type of thinking.
I got this question from somebody recently in kind of career context. If you were to identify the structural themes and trends that are likely to continue if people were trying to position with the wind on their back, is it, you might have said private markets, but then there's extensive, is that gone too far? But I mean, if you were to identify 2 or 3, what would you say?
So I've got one clear bet on, which is the growth in importance of global asset owners. Sort of global asset and asset managers. That was the view I took when I joined LPPI in 2017. It's worked. I think that trend is still in place, that you're seeing more larger pools of sovereign capital growing and being run, as we talked at the very start of the podcast, in a more structured way with using industry accepted best practice, all that type of thing. So I see that continuing. I think private markets will continue, but I think the more important piece is the blurring line between private and public and the hybrid securities and the breakdown that what was traditionally public and private, I think, is being blown apart, and the holding structures. And that sort of bleeds maybe slightly into tokenization, crypto. There's a lot of change coming there. There's a lot of inefficiency in the financial intermediation or in the way that the plumbing of the system. And I'm not smart enough to know exactly how it plays out, but to see that, whether it's stable coins or tokenization of assets, I think that's coming. And I think that could lead to, certain businesses more precisely just disappearing. Just suddenly the reason to exist just goes, because if you can directly own assets via a token, well, that might change things. So I'm not expert on that, but I can see there's a lot happening there. And what would the third one be? I think it would be strap-on seatbelts for, I wouldn't be betting on the next 10 years looking like the last 10 or 15. I think, if I'm going to put it into context, I think rates will be higher, inflation will be higher, geopolitical tension will be higher, asset returns, spreads will be thicker. You need to be compensated for that risk. The risks have been wrong, I think, could be materially higher. And, to nick the BlackRock idea that we are potentially in this unanchored world where, I don't think inflation is going to be nice around 2%. I think central banks have got a game on to try and hit that. And I think, if I had to put one word in it, fiscal dominance type thinking. I think so. Be very aware of risk and be mindful. But to counter that, what I'd say as well, owning a broad portfolio of risk assets that you manage thoughtfully and be sensible with, I think will outperform in the long run as well. So don't be scared and run to, Bitcoin or whatever wholly.
Could just be a rocky ride.
Yeah, just might be a bit bumpy.
Very good. Well, very much appreciate you coming on today, Richard. It's been great. We've covered a lot of ground, so very much appreciate it. So for our listeners can obviously follow the growth of LPPI and your work over time. But from us here at Top Traders Unplugged, thanks for tuning in, and we will be back again soon with more content.
Thanks so much for having me on.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.